All right, what's going on, guys? This is Nick, CEO and founder of Rival Consultants. Today, we're going to go over, today's mortgage requirements, i.e., 2018. It's not going to be the quick 5 to 10 minute videos that I normally do. This is going to be more in depth, maybe 20 to 30 minutes. So, just give you a heads up, and we're really going to go in, talk about the mortgage requirements, loan to value ratio. Really just some basic real estate stuff for you guys looking at buying real estate or homes, different things that you want to, take note on before you even go to a mortgage lender. All right, let's go ahead and get into it. Will I need a down payment? That's the first thing you think about when buying a home. How much am I going to have to put down? It's possible to buy a home without a down payment, but it's a good idea to approach lenders with a down payment in hand, whether it be FHA, 3.5, 20% down. Also, if you're looking to invest, possibly 35% down. It all depends. One of the mortgage requirements that determines your eligibility, in addition to the minimum credit score for mortgage loans, is your loan to value ratio. The more favorable the ratio of how much a property is worth to the amount you're borrowing, the more qualified you become. What is loan to value ratio? The loan to value ratio is a lending risk assessment ratio that financial institutions such as banks, mortgage institutions, it's really what they examine to approve you for a mortgage. Typical assessments with high loan to value ratios are generally seen as high risk, and therefore, if the mortgage is approved, the loan generally costs the borrower more to borrow. Additionally, a loan with a high LTV ratio may require the borrower to purchase mortgage insurance to offset the risk to the lender. Loan to value ratio, the best case scenario, you want to have a maximum LTV of 20% or a 20% down payment. Lower LTVs are better and can help you qualify for a better interest rate. If you're not able to save up enough for a down payment to keep your LTV below 80%, you could be required to purchase a private mortgage insurance, even if you're not using an FHA home loan. The second question is, how much can you afford? This is another big one also. It's good to be able to determine how much you can afford before you start looking for properties. Do you want a $100,000 home, $200,000? That's something that you want to take into account, the amount of money that you make, the down payment, how much debt you have. Do you have credit cards that's maxed out? Do you have loans open? There's different things you want to take into account before, before you go and purchase a home. Pre-approvals versus pre-qualification. When you're ready to start shopping for a home loan, you're going to encounter pre-approvals or pre-qualifications from various lenders. What's the difference? Pre-qualification does not require your social security number and allows you to compare loan details without having your personal credit assessed. Pre-approval means the lender runs your credit and evaluates your finances. It's the most accurate way to shop for a home loan. However, it does require your social security number, resulting in hard inquiry on your credit report. I can't really speak for other states, but I know here in Louisiana, before you can even walk into a home and look at it, you have to be pre-approved. It happened to me a few years ago. I was looking to buy a home. First thing they said, okay, before you can even look at a house, you got to get pre-approved. Once you're pre-approved, then you go look at the house. Like I said, I can't speak for other states, but that's something to take into account as well. So your credit's a 5 something. Don't try to go looking for a mortgage. You want to be at least a 620, because with a 620, you're able to qualify for FHA. How much down payment do you need? Coming to the table with at least 20% is ideal. However, if you can only manage 15 or even 10%, you'll be in a much better position when it's time for closing. The more you can put down at closing, the more ownership you will have, and the less you have to pay in financing over the lifetime of the loan. Debt to income ratio considerations.